analyze a company's financial statements. And this analysis goes beyond just looking at the balance sheet or profit and loss statement. This is why we have ratios to get a complete picture of the company's performance. Ratios standardize numbers and facilitate comparisons. And ratios are used to highlight weaknesses and strengths. And the ratio comparison should be made through time and with competitors. We can have trend analysis, industry analysis, and benchmark analysis. And these ratios can be split into 5 major categories. We have liquidity ratios, which gives us an idea of the firm's ability to pay off debts that are maturing within a year. Then we have asset management ratios, which give us an idea how effectively the firm is using its assets. Then we have debt management ratios, which gives us an idea of how the firm has financed its assets, as well as the firm's ability to repay its long-term debt. Then we have profitability ratios, which gives us an idea on how profitable the firm is operating and utilizing its assets. And the last category is market value ratios, which bring in the stock price and give us an idea of what investors think about the firm and its future prospects. But let's see this in practice. I have pulled out data for one company, and I have profit and loss statement and balance sheet ready. And I have calculated our ratios. Let's analyze them. Current ratio measures the ability of the firm to pay off its current liabilities by liquidating its current assets. It indicates the firm's ability to avoid insolvency in the short run. Usually, analysts perceive current ratio of 2 as acceptable. And in our case, the liquidity is stable. Quick ratio is a better measure of liquidity than the current ratio because inventories and other less liquid assets are deducted from the current assets. Inventories are typically the least liquid of the firm's current assets, and if sales slow down, they might not be converted to cash as quickly as expected. Return on assets, or ROI, shows how much net income is generated by total assets. It's obviously better to have a higher than a lower return on assets. One quick note is that a low ROI can result from a conscious decision to use a great deal of debt, in which case high interest expenses will cause net income to be relatively low. Stockholders expect to earn a return on their money, and this ratio tells how well they're doing in an accounting sense. However, if a high ROE is achieved by using a great deal of debt, the stock price might end up lower than if the firm had been using less debt and had a lower ROE. In our case, the ROA is okay. Everything that is above 5% is good, and everything that is above 20% is excellent. But we can see that our ROA has been slowly deteriorating with years. And our return on equity is also good. Return on sales is a financial ratio that calculates how effectively a company is generating profits from its top line revenue. And for most companies, a return on sales between 5 and 10% is excellent. And in this case, our is 6.72%. Operating margin measures operating income per dollar of sales. And in our case, each dollar gives us 12 cents. Net profit margin measures net income per dollar of sales. And in our case, $1 of sale generates 0.06 of net income. As a rule of thumb, 5% is a low margin, 10% is a healthy margin, and 20% is a high margin. And we are doing relatively okay. We can also calculate the return on invested capital. In this case, profitability of the business is decreasing with years because our economic value added is negative. And this is the estimate of the value created by management during the year. Economic value added, or EVA, differs substantially from accounting profit because no charge for the use of equity capital is reflected in accounting profit. And EVA measures all the costs of running the business from both operating and financing. Our debt management ratios, or leverage ratios, shows that we are dealing with a high leverage, and we have 88% in 2015. And our assets are 8 times higher than our equity, and the time interest earned tells us whether we can repay our loan with operating income. In this case, we can cover 5 times our obligations, but this has been decreasing over years. For our Asset management ratios or activity ratios. This is a set of ratios that measure how effectively the firm is managing its assets. Basically, this answers this question: does the amount of each type of asset seem reasonable, too high or too low in view of current and projected sales? These ratios are important because when companies acquire assets, they must obtain capital from banks or other sources, and capital is very expensive. If a company has too many assets, its cost of capital will be too high, which will depress its profits. On the other hand, if the assets are too low, profitable sales will be lost. Total asset turnover shows how many times the particular asset is turned over during the year. In our example, this is very low, and it shows how much dollars of sale can be generated by the usage of $1 of total assets. Our fixed asset turnover measures how effectively the firm uses its plant and equipment. A higher turnover ratio is indicator of great efficiency in managing fixed asset investment. Inventory turnover, it's okay because $1 of inventory generates $5.2 of cost of goods sold. In general, efficient firms don't tie up more capital than they need in raw materials and unfinished goods. Our supplier's credit could be better. Days of sales outstanding indicates the average time firm must wait after making a sale before it receives cash. And in our case, this is too long because we have to wait 426 days to get cash. So the company should fix its credit policy. And we have enough inventory to maintain business for 69 days, but we need to pay our suppliers very quickly within 136 days. And there's a huge mismatch between this number and this number. So we have to wait for a well long time to get paid, and we have to pay our obligations quickly. Then we have our market value ratios. Earnings per share indicate how much money a company makes for each share of its stock, and it's widely used metric for estimating corporate value. The higher a company's earnings per share, the more profitable it is considered to be. And then we have the price to earnings ratio, which is the ratio for valuing a company that measures its current share price relative to its earnings per share. In our case, price to earnings ratio is high, and it means how much we are willing to pay for the stock. And this is because our company is not considered risky. And for the last analysis, we have dew point equation, which splits ROE into parts to see which factors are affecting the firm's ROE. And in our case, the ROE is not the consequence of good profitability, but the consequence of huge leverage. And you can see how ROE can sometimes be misleading. Thank you for watching. Welcome to another video on financial ratios. Ratios are very useful to see how the company is doing. However, you always need to compare ratios of one company with other companies in the same industry, and also with industry average. And you can do this for the last 3 or 4 years. Sometimes one ratio seems bad, but when you compare it with industry average, then you might realize that your company is doing well. In our example, we have 2 companies, Company A and Company B. And we have the industry average. When you don't want to calculate ratios on your own, just go on Yahoo Finance and type in any company that you want to analyze. Under Financials, you will find all the statements that you need to calculate your ratios. And under Statistics, you will find all the ratios that you need. In our example, you can see that the Company B has good liquidity ratios, is doing better than Company A and better than industry average. ROE is also very good, and our operating margin is also above the industry average. ROA, on the contrary, is poor, below industry average, and the same goes for total asset turnover and inventory turnover. Overall, we can conclude that Company B is a risky company due to high leverage levels and has difficulties with asset management. Thank you for watching.